With memories of stock market volatility fresh in our minds, and the looming fear of massive national debt bringing inevitable future tax increases, the American public is justifiably concerned about their retirement savings. That is why getting it right with your retirement dollars is so vitally important. Patrick Kelly's book, Tax-Free Retirement, was written to help you understand a time-tested yet startlingly unknown plan to accumulate long-term savings that can minimize the severe impact of future taxes. Patrick's book covers a wide range of topics important to anyone contemplating retirement. For the sake of brevity, we'll focus on the section titled Hidden Retirement Traps. Retirement Trap Number 1. The Tax Trap. Let's look at the makeup of a typical retirement account. Someone contributes $100 per month to a 401k, IRA, or other tax-qualified plan. After 30 years, that person has accumulated $36,000. If the growth rate averages 10%, that $36,000 contribution grows to $226,000. Because the plan was tax-deferred, the tax on the contribution is delayed until retirement. If we assume a conservative net tax rate of 20% after mortgage deductions and deductions for the children, the individual would have delayed $7,200 in taxes until retirement. Generally speaking, and contrary to popular belief, an individual's tax rate is lower in the early years of their career, not just because they are earning less, but also because they have more deductions. In order to calculate the individual's tax liability in retirement, we'll assume a conservative 20% retirement tax rate. This equates to a retirement tax liability of $45,210. In reality, this individual's tax rate could easily be 30 or 40%. At 30%, the tax liability totals $67,815. At 40%, the tax bill jumps to $90,417. Suddenly, saving $7,200 becomes less appealing. Remember, every dollar withdrawn from a 401k or IRA is going to be taxed, both interest and principal. Tax-qualified plans do not avoid tax. They simply delay the tax. And by delaying the tax, these plans make the tax burden worse, often much worse. In his book, Patrick Kelly shows you how you can pay the $7,200 today and withdraw the entire $226,049 tax-free. Not tax-delayed, but tax-free. Retirement trap number 2. The access trap. What if you need to access your money for your daughter's education or for an emergency? Keep in mind that any money withdrawn from your 401k IRA account will be added to your existing income, sending your tax rate skyrocketing, not just on your withdrawal, but also on your entire income for the year. If you are in your peak earning years at the time of withdrawal, it's possible that you will be pushed to the top marginal tax rate. Factor in state tax and the 10% early withdrawal tax penalty, and you are crushed with a 40 to 50% tax on your withdrawal. It doesn't have to be that way. Wouldn't it be better if you had full access to your money at any time, at any age? Patrick Kelly's book will show you how. Retirement trap number 3. The distribution trap. According to the rules, the government wants you to access your retirement account between the ages of 59 and 70. Why? It should be clear by now that the government wants its cut of your retirement savings. But what if you don't need the money? Can you let it accrue and pass it along to your heirs? The answer is frightening. If you do not take the minimum distribution for a given year after age 70, you will be subject to a 50% excise tax on the amount not distributed as required. Again, it doesn't have to be that way. Patrick Kelly's book will show you a plan to accumulate long-term savings and minimize the severe impact of future taxes. This book is a must-read for anyone contemplating retirement. Whether you're a doctor, business owner, wealthy, or just concerned about getting it right, Patrick Kelly will provide a useful and practical guide to planning your retirement. If you would like to receive a free copy of Patrick Kelly's book and a personalized illustration of Patrick Kelly's solution, complete the information at the right.